So I think just thinking through how related some of these things that people are trying to accomplish are, right? Like you want to minimize taxes, you want to think about the next generation, you want to maximize your estate planning, all these things is sort of a Rubik's cube of sort of different issues. And so, there isn't really a cookie cutter way to do things. And so, getting your team to really think about what's the best way to do, whatever you're trying to do, whether it's
Hey, everybody, welcome back to another episode of the Richard Geek Podcast. Today we have David Flores Wilson. He's a top financial strategist for entrepreneurs, tech professionals, business owners. He was named Investopedia's top 100 financial advisor. He's been featured on CNBC, New York Times, Kiplinger. We all know what those are. He helps clients maximize wealth, optimize equity compensation, and a lot of things you guys don't realize is the exit business plan. How you doing, David?
doing well. Excited to be here and have the conversation again. Thank you for all the work you do in financial literacy. It's a great area where it's not taught in the schools, and so the work that you do is really really helpful to people listening. So
Yeah, that is the truth. It's even college level. I've hired some MBAs and they have no idea what a lot of this stuff is. I'm like, what do they teach you guys anymore? I don't even want to get started in it. But before we get into the meat of our podcast, give us a little bit about your background, how you got involved in financial services area.
sure. I mean, it started pretty early. I think my dad was a CPA, and so I always got little sort of nuggets of financial literacy growing up. And on the other side of the family, my grandparents had a series of family businesses, and so I was working in those different businesses growing up on summers and weekends. And then what I saw is that they actually didn't make a lot of good decisions, right? So they lost one of their businesses because they didn't have the right coverages, they didn't have the proper estate plan in place, and so that kind of really inspired me as I had an investment banking career after college, and then I shifted to financial planning, which was my passion. I was kind of doing that as a hobby, and so I make sure I work with founders and owners so that they don't make some of the same mistakes my grandparents made, so that they can advance the ball and really have good outcomes when it comes to financial planning.
So, a lot of people say, hey, you know what? I have my CPA. I may or may not have a financial planner. I have this guy that I buy and sell stocks with, got a couple mutual funds. I'm an entrepreneur. I mean, that doesn't work for self-employed, does it?
Yeah, I mean, I would take a step back and say whether you're an owner or a serial entrepreneur, financial planning is fundamentally different
Hmm.
for people like us, right? That own businesses, that are in the trenches, making decisions on hiring and allocating budgets, and so it takes a different approach, right? And because entrepreneurs, they're comfortable taking risk, but it's they want to define that risk, they want to control that risk as well. So many entrepreneurs, they have the vast majority of their net worth tied up in their business or their real estate.
Yeah.
And so, it takes a specialized, set of skills to kind of look at that situation. Because I think a lot of advisors might look at a business owner's balance and say, hey, you need to diversify right away. And oftentimes I'm like, well, I mean, do they really, right? Let's really understand,
Hmm.
what's the rate of return in their business. And, if that rate of return is over 20%, most of the times it makes more sense to put more money into the business than to take out of it, of the business and put that in a brokerage or a 401k. And so, just being very intentional about that sort of capital allocation, considering, where that business owner wants to go, considering, how effective, that business is as generating a rate of return, relative to the stocks and bond market. And then again, I think you're also alluding to, that there's so many different ways to save money on the tax side. And so just partnering with the right CPA and putting it together a full team and saying, hey, well, what are the ideas that we have whether it's, structuring ideas to save money on taxes, or, with the entity itself, or, the deductions and credits, maybe deferral accounts, or even just emphasizing long-term capital gains or, versus ordinary income. I just getting the full team to think about that, and kind of updating your team over time, if that makes sense, as sort of business owners, entrepreneurs kind of level up their own business, right? So,
Yeah, because a lot of it is, I mean, we pay enough taxes,
yeah,
and a lot of us, we take our own withdrawals, we take our salaries, and it just goes into a savings account. And because we like seeing that I have cash, but that's not working for me. It's like, why did you grow this business? Why did you do all of this to get basically 0% return? Why are you not doing these tax deferreds? Instead of putting it all just kind of like an employee where you put it into some type of an IRA, some type of a deferred account. So what are some of those different things? We probably have a lot of entrepreneurs listening, and they're like nodding their head. They're like, oh, yep, I've got a lot of money in the bank. What are some of the things that we can do just to help us kind of defer um, taxes, or just kind of defer our income? Because I don't need a lot of income now, but I'd like to defer it and pay the taxes,
yeah,
another 20 years or so. So what are some of those things that the entrepreneurs can do?
for sure. And I think that, there's sort of a whole category of things when it comes to deferral, right? And I think that, a person's particular situation matters a lot. And so,
Mhm.
in New York City, where a lot of, the business owners and entrepreneurs I work with are, if you're able to defer in New York City and sort of avoid paying New York State and New York City taxes, and then one day, you sort of, retire from the business or sell the business, and you're in, Florida or Texas, and it's going to come out of those deferral accounts, and not pay any sort of state or city tax at a time. And so there's a little bit of an arbitrage, right? So you're sort of
Yeah.
saving maybe 37% at the federal level, maybe up to sort of 12% at the state and city level, and then it kind of comes out later, and you can be smart about when you make those distributions. But for some people, that's not the case, right? They might actually move to New York City in sort of retirement, whether they want the, you know, see see some shows, or they want,
Yeah.
they prefer the doctors in New York City, or whatever it is. And so that decision might make say, hey, okay, maybe it doesn't make sense for that person to defer in a low tax state
Mhm.
in their working years, and then take the money out in retirement. And so every situation is a little bit different. And so just kind of thinking through, running the projections,
Mhm.
and even the business themselves, right? I think that some people, um, there's an opportunity called qualified small business stock, which has a $10 million capital gain exemption when you sell your business. But there's a lot of requirements, right? It has to be, it can't be a service business like, my business. It usually flies really well to sort of software businesses that are high growth. And, that business, if it's a C Corp, if it's, more than 5 years, and then they sell that business as a stock sale, well, then yeah, they could have a $10 million capital gain exemption. And so all those kind of little different strategies, and kind of thinking through the pros and cons, 'cause for some people that's, completely not appropriate, right? It might make sense to say, hey, I'm going to be an LLC. I'm going to
Yeah.
flow through the losses in the early years of the business. And C Corp doesn't make sense with, potential double taxation. And so, but maybe it might make sense, hey, to start with an LLC and then go to a C Corp later, right?
Mhm.
And so I think that, having the right team to sort of think through all these kind of different permutations to save taxes on the structural side, on the deferral side, and of course the meat and potatoes of the regular deductions and credits and things like that that most CPAs are pretty good at. So
Yeah. Yeah. And ladies and gentlemen, I'm sure a lot of you have just regular CPAs and things like that, but my God, it wasn't until I started having people on my podcast, or listening to people like you. It's like, you go ask your CPA, and it's like, do we do this? Do we do that? And they're like, no, you didn't ask me to. Well, you know, so the difference of having an advisor who actually says, hey, let's sit down. on a regular basis, go over your pro forma, what you're going to do next quarter, and have some talks, and then they actually ask you, why are you not doing this, or are you doing this? Do you want to do this? It's light and day sometimes with finding the right type of advisor. You can still have your CPA, you still have your fractional CFO, but they have to partner with someone or have someone on their team that knows the entrepreneurship side.
Yeah. Yeah, our experience oftentimes with the client base is that, and not to talk bad about the CPA business, but I mean, the CPAs have so much knowledge, right? And so,
Mhm.
but over time, what we've seen in the marketplace, and there's a variety of reasons for this, the increasing complexity, new tax law changes all the time,
Yeah.
as well, the marketplace sees them sort of as a cost center rather than so many, oftentimes, they're doing sort of a volume business and doing tax
Mhm.
returns, even though they have the knowledge to sort of, to do advisory work. And as well, not many people are coming out of college to want to go into the accounting profession, and so
Yeah.
they're sort of fighting for that junior talent. And so, frankly, many of them are overworked and have too many
Mhm.
clients. And so, finding the right one, if once you've found it, the person that can really partner with you to think through the intricacies of your business or businesses, and what sort of applies, and the pros and cons of different different strategies. Because I think there's no free lunch, right? I think there's sort of whenever it sort of comes to kind of some of these strategies, right? Because
Mhm.
there's pros and cons. So
Yeah, and what do you think about, another thing that my CFO was asking, it's like, why are you doing all your charity work through your own personal side? And I'm like, oh, I don't know. I have money in the bank and someone wants money in or a large sum and I do this. And then, they're talking about, what is the private foundations or the DAFs, it's like,
yes.
why are you not setting these things up? And I was like, because no one told me about them. I thought that foundations were for like the Bill Gates of the world and, things like that. So talk to us a little bit about that type
Yeah.
of thing.
On the charitable side, it is pretty interesting, right? Because sometimes we'll meet a new prospect or a client, and charitable giving will come up, or maybe we'll see it on their tax return. Um, and so well, actually, so, sometimes we see people where like they're like, okay, I'm getting a huge deduction because I give to charity, and then then when you see the tax return, you're like, oh no, this person's taking the standard deduction, right?
Yeah.
Um, and they paid off their mortgage, so they don't have a lot of itemized deductions if they went that way. And so, whether it's the mortgage interest deduction or the charitable deduction, to really understand, okay, well, is this really actually, are you actually getting the deduction? And if you're not, well, maybe it makes sense to bunch up the charitable giving you're going to do over the next 5 years. And so if you're going to give $5,000, per year for not the next 5 years, well, then let's bunch it up in the first year to guarantee that you're going to be itemizing. And that way you'll for sure get the deduction, and then distribute those funds from the donor advised fund to the charity. And then, let's double up the strategy, right? Let's like, okay, when we donate to the donor advised fund, let's donate, um, you know, shares of stock, for example, maybe liquid securities
Yeah.
that have appreciated a lot. And so that way you avoid the capital gain, and then you also get the deduction. And there's, as well, like, I think when it comes to exit planning and people kind of selling their businesses at some point, these charitable strategies can also be very helpful. Right? There's strategies where maybe they might want to think about. We've seen a family, for example, there was a succession to the next generation, and so they had already gifted some shares to the second generation, the children, and they were sort of working in the business. And instead of sort of just continue to give more because they were instead of there would be gift tax implications if they gave too much. And so what they ended up doing is they gave some shares to a charitable organization,
Yeah.
and then they did what's called a charitable buyout or a charitable redemption. And so
Yeah.
the shares were purchased from uh, by the entity. They were purchased from the corporation, and the shares were then retired. And so what ended up happening was they got a deduction, giving the shares to charity, and then they kept the shares in the family. And as those shares were retired, the percentage of shares that were owned by the children went up because there were fewer shares outstanding. And so I think just thinking through how related some of these things that people are trying to accomplish are, right? Like you want to minimize taxes, you want to think about the next generation, you want to maximize your estate planning, all these things is sort of a Rubik's cube of sort of different issues. And so, there isn't really a cookie cutter way to do things. And so, getting your team to really think about what's the best way to do, whatever you're trying to do, whether it's, do a succession, sell your business, or just, kind of maximize cash flow. All those different things.
Yeah, and it's kind of weird. You can also kind of plan and choose depending on the attitudes of like the White House on whether or not they want to tax more or tax less. And because I've had people say, you know what, let's hold on to it and don't do anything until the next election to see then what they're thinking. And I never thought about it that way. It's like wait till this certain type of person goes into Washington because they may um, the estate planning and what you do with the taxes and the wealth taxes. And so that's also kind of plays into whether or not you want to do something now or you want to kind of defer it down the road.
Yeah, absolutely. Right now I think the federal estate tax exemption is 13.99 million per person. I think we can sort of expect that to sort of be maintained. Again, this could happen any day now, or it could happen, in December, when the extension of the Tax Cuts and Jobs Act of 2017 goes through or not. But yes, I think there were many people sort of that were considering, hey, I'm going to take advantage of this sort of gift tax exemption and kind of do it in 2024.
Mm-hmm.
For the most part, we're saying, hey, you know what, like it, probably makes sense to just wait a little bit, right? Until we get a little more certainty. And so you can imagine over the course of, the next several decades, the estate tax and the gift tax and
Mm-hmm.
even the brackets themselves and on the
Yeah.
income side could change dramatically and switch back and forth. And so, I think the key is sort of to have a plan. Sometimes you want to move quickly, and other times you just sort of want to delay that decision.
Mm-hmm.
But I think a lot of times, we see people that, even inertia itself is a decision, right? And so
Mm-hmm.
we really, advise people to let's be intentional about what we're doing. Even when we're just waiting, it's got to be an intentional decision, right? Because I think,
Yeah.
but yeah, I think there's a, old Chinese proverb, right? You make a law, you make a business. And so I think that applies to investing. And even, when we had a big sell off here in April,
Yeah.
as there was uncertainty in the markets, that's an opportunity for
Yeah.
investors and owners to sort of maybe tax loss harvest some positions, right? Say, okay, well, I bought it at 100, it went down to 80. Maybe I can sell it, take the $20 loss, buy something else, and then when that $80 goes back up, I catch the upside, and I also got that tax loss harvesting that I can apply to my investments. And so,
Mm-hmm.
that's something that, for example, someone's selling a business, they might want to, supercharge tax loss harvesting because they can apply all those built up losses to a capital gain potentially when they sell their business. And so,
Yeah.
that's one of the things you can
It's
do.
and talking about the stocks, it's more of an emotional thing. Stocks, someone sneezes, everything goes down. Someone else, it's like this roller coaster. And let's talk a little bit about. And I'm actually getting more investors on the real estate side because people are just like, man, they're not getting out of stocks totally, but they're like, I'm getting too old to handle all this stress and this anxiety. Let's put something in something that, you know, doesn't yo-yo as much. So talk about stocks versus real estate. They can both build wealth. Both of them are great things. So what is your take on wealth building between the two?
Yeah, great question because I think that in the tax code, you know, the real estate investing side of it is unbelievable, right? Like the
Hmm.
ability to save money in taxes when you
Hmm.
purchase, when you manage, when you sell, whether it's a 1031 on sort of the reinvestment of a sale, whether it's the, you know, um, cost segregation studies so you can get
Hmm.
accelerated depreciation, um, whether it's being actually a real estate professional and
Hmm.
getting those 750 hours and sort of applying losses on the real estate to regular income. On the tax side, so many of those things that you don't have a parallel sort of system of those sort of tax saving side. And so for me, I think, it isn't an either or. It really depends on the person, right? So I think that there's clients that we work with that have built up incredible portfolios and are kind of sitting on that income they've generated, and they've generated essentially because there's been an excessive amount of depreciation over many years. Then they haven't really paid a lot of taxes on that income, and then
Right.
so they depreciated those properties to very low amounts, and they're planning on giving those properties to the next generation. And so that next generation will get a step up in basis to market. And so if they passed away and their heirs sold it the next day, well, they would pay no taxes on it. There'd be no capital gains. And so, but that's a very specific person, right? They're had a long-term view, and they also had a comparative advantage, right? They were good at identifying properties. Other people's comparative advantage could be maybe their cost of capital, or maybe finding good managers, right?
Mhm.
Or saying, hey, like I'm really good at, whether, someone could be fine, good at sort of identifying particular real estate sectors, whether it's hospitality versus residential. And so it really it's a lot of sort of introspective, right? In terms of like,
Yeah.
okay, well, what are you really good at? And can you add value, on the real estate side and take advantage of these things or find the right partners to do so? Um,
Yeah.
because I do think that, I think, there's times where like, we have clients who are saying, okay, well, like, this is a property I'm investing. We'll run some pro forma models on that
Hmm.
and kind of test their assumptions around rental increases and repairs and all that. And we do the financial modeling, and, we'll have an internal rate of return of, 18, 19. I'm like, let's do that. Right. Let's like, that sounds awesome. Right. And other times we'll run it and it's like, got 7%. I'm like, okay, well, we have an illiquid asset that can't really diversify. And so relative to diversified portfolio, I'm going to lean, on this particular project towards a
Hmm.
more diversified portfolio. And then when you find the project that has that great IRR, then we'll take the money out of the investment account, out of the
Yeah.
brokerage account, and put it in that property. So I think it really depends on the person and, of course, the project and what the overall balance sheet looks like for sure. So
Yeah. And I think a lot of people that are still working, that's why like the limited partnership being an LP
yeah,
stands out for them. It's like, I can get a lot of that same thing, but I don't have to even think about, just get my distributions, roll it over if I want, and it kind of allows them to just kind of diversify the portfolio. So that's why we're seeing a lot of people
yeah,
wanting to be limited partners because they understand that real estate is it. Or real estate can really help them, especially when the K1s come out, but they don't have the time or the effort or even the knowledge.
yeah,
And they don't want the knowledge. They just want to know that where's that IRR? What am I getting? So we're seeing a lot of that, especially in today's market with people just doing the LPs. So let's talk
yeah,
about people that are entrepreneurs. They have businesses. One of your specialties is the exit strategy. And most of us are probably thinking about it wrong or doing it wrong. And they don't even think about it until, oh, you know what, I'm old. Let's sell now instead of selling thinking about the exit strategy when they first start the business.
yeah. Yeah, I mean, our view is that when it comes to exit planning, it's something should be, people, entrepreneurs and business owners should be thinking about when they form their business, right?
Hmm.
Because I think that the decisions you make when you form your business can inform, what type of exit plan situation you have. And so the sooner you start, the better it is, right? And I guess kind of everyone says that about everything, but I think that exit planning can just be good business, right? To
Yeah.
get ready from a personal perspective, from a financial perspective, and a business perspective, can actually increase the value potentially of the business itself, right? And
Yeah.
so you can kind of do the exit planning, create a more valuable business,
Hmm.
and decide not to sell the business or to go forward, right? And so I think that and it's part of that discovery process because some of the structures the education process, it's going to take a while, right? In terms of just, because I think if people go quickly and they sell their business very quickly, people are going to come out of the woodwork and say, hey, you should do this, you should do that. This is a way you can save money on capital gains. This is a way you can save money on the earnout. And if, so I think business owners sort of need to really understand the pros and cons, whether it's a charitable structure or it's a, capital gains mitigation structure, or otherwise. Exit planning can kind of help that. And so, and just, that process of saying, hey, how would someone else look at my business, right?
Hmm.
How much recurring revenue is there? What do the processes and systems look like?
Yeah.
Do I have a repeatable sales funnel that integrates very well with my marketing? And, what's
Mhm.
our do we have any risks on the technology side or on the legal side? And so just kind of going through all those checklists and kind of getting ready. Are my financials are ready to go, right? Do I have a system, a financial function that, has regular monthly reports and I can kind of toggle up and down based on my, KPIs and understand how my business is going to be doing and what my tax liability is going to be. And so exit planning is really just sort of saying, okay, let's get ready and make the business more attractive, but then also getting someone personally ready, right? Are they ready to step away from the business eventually? Because so many business owners regret selling their business, right? Even a
Sure.
year later. And so, we oftentimes will just literally just do like a time audit, right? Say, hey,
Hmm.
like, what are you spending your time on? And
Hmm.
what pro forma will you be spending your time on when we sell the business? And so, you're saying, okay, well, you want to golf more, you want to spend time with your grandkids. Okay, well, that's 10 hours a week. Well, what about the other sort of
Yeah.
110 waking hours of the week as well, right? Let's be very intentional about it. Let's find your identity is going to change, right? Are you going to be able to say like, are you going to be okay to say like, oh yeah, I used to own a business as opposed to I'm a business owner?
Hmm.
Um, and are there
Hmm.
passions that maybe, your vision will shift, right? And so like, transitioning to something is a big part of exit planning, not just the transaction itself, which of course is, super important, just kind of understanding, okay, well, what are your preferences in terms of the stakeholders, right? It's
Yeah.
are you trying to preserve legacy, and so maybe might want to do an ESOP or a management
Hmm.
buyout? Are you trying to just get the most after tax proceeds, and then maybe a strategic buyer, a competitor or someone sort of looking into get into new markets or something like that would buy your firm, or is this a succession, right? Do you care about keeping your name on the door and having that go to family? And how can you do that? I mean, how do we mentor the next generation? How do we develop them? And so all those different things are part of exit planning, and it can seem so overwhelming, but I
Yeah.
think that just chipping away at it, sort of
Hmm.
90-day sprints in particular areas, and just having in very discrete subject areas, and then you're in a much better position just a few years later. Whatever the option, yeah, the business owner wants to pursue. So
Yeah. And ladies and gentlemen, it's David Flores Wilson at, see if is it Sinceris?
exactly, yeah. Sincerest
Sinceris
Advisory.
Advisories. When people go to your website, sincerisadvisories.com, is that correct?
SincerisADV.com. Yeah,
adv.com.
yeah,
What do they
exactly.
find on, when they go to that website? How can they get a hold of you? Is there any educational material?
Yeah, so we have a blog that's focused on business owners and entrepreneurs.
Mhm.
It links from the main site. It's called Planning to Wealth, and
Mhm.
so some of the the structures and some of the financial planning techniques that business owners might want to consider are there as well. On the website, if they want to chat a little bit more
Mhm.
about their personal situation, they can do that on the website as well. So
Yeah, everybody, again, David Flores Wilson, if we've kind of piqued your interest that perhaps there should be a little more strategy in your life as far as taxes go or financial advising, reach out to David Flores Wilson at Sinceris Advisory. David, it's been a pleasure having you on. Thanks for your time and have a great afternoon.
great chatting with you. Thanks.